All right, guys, for more on all of this and the market outlook overall, let's bring in Katerina Simonetti of Morgan Stanley Private Wealth. She's a senior vice president, also a private wealth advisor at the firm. Thank you very much for joining us, Katerina. You heard the conversation from the desk. I wonder, from your perspective, if you are managing people's money, do all of these things matter in that conversation about how 2025 shapes up?
Well, absolutely. When we think about 25, we are expecting some type of a mid to high single-digit returns. Market return 26% this year in S&P, followed by 24 last year. So it is only reasonable to assume that this level of growth is going to slow down and something is going to have to give. And of course, this assumes that we're going to see a couple of more Fed rate cuts and inflation is not going to spike up. But it will be safe to say that 2025 could be categorized as another year where it's all going to be about the Fed and inflation.
Okay, so if it really is, how much then do investors have to be reactive, Katerina, to the Fed? Do we just have to wait until they say or do something, or is there a way that you proactively position for it?
Well, it's a very fair statement. And, when we look at the risks that the market is facing, there's not much we can do about the Fed or tariffs or the headline news that might be hitting us at the beginning of the year. What we have control over is our portfolios. And we tell investors that reaching the maximum portfolio diversification among stocks, bonds, real assets, and alternatives, this is something that we can do. And it's an absolute key in dealing with this market.
Katerina, where do you get concerned in terms of 10-year yields? We're 4.6 now. For a lot of people, it's 4.5%. Other people say it's going to be the levels we saw in the fall of last year. Where does the 10-year yield go where equities sort of put up a caution flag?
Well, bonds definitely surprised us, and the key here really is what's going to happen with inflation. Because if inflation were to spike, we like bonds on the risk-adjusted basis versus stocks. So it is difficult to see where the rates exactly are going because there are so many risk factors facing the market. But we think bonds play an essential role in the portfolio with equity risks out there.
Katerina, sort of a piggyback on your Fed outlook and Guy's question on the 10-year. During my career, you bought the market at 17, 18 times, maybe even 16 times if you were lucky, and you sold the market at 21 times. Rinse and repeat. You sort of just followed it. That was your 50,000 foot up, top-down approach to how you traded the indice. How do you see valuations fitting in with your forecast for the S&P target and with your Fed and your 10-year, obviously, your ideas on that?
Of course, market is extremely rich, and not only in terms of valuations, but also in terms of earnings projections. And it's going to be a tall order for us to actually meet all of the things to come together for us to continue the growth in the market like the one we have been seeing. So what we tell investors is that they should focus on individual stock selection versus index investing, on absolute quality. We like large caps over small. And the sectors like financials, energy, consumer staples, we're taking very protective stance and with focus on the dividends because there is going to be a lot of volatility next year. Even though we're optimistic on the market, we think we're going to end up the year at about 6,500, but quality is the name of the game.